And I wonder, you have a lot of expertise in investing in technology. Why are you still a little wary about dipping your toes into certain parts of that technology market?
The essence of that question is because I just don't have confidence in some of the management teams in the growth arena to be able to execute through an uncertain period that no one's really seen before. So where I do have confidence is with the Alphabets of the world and with the Amazons of the world, who have proven that they can juggle balancing capital allocation to invest in growth with making sure they've got the discipline to keep costs under control. They're the kind of proven executives who've done it. I don't think in a lot of the growth space we've got that kind of sitting expertise quite yet.
So if that's the case, it does suggest then that the companies with the most experience, the most seasoned ones out there, you mentioned the Amazons, you mentioned the Alphabet parent company of Google. Does that kind of mean that the Microsofts, the Apples, even maybe Meta platforms are the ones that you want to go into, despite the fact that we've seen certain of those stocks tank over the course of the last year?
Yeah, I think Meta is definitely one that I'm staying away from. And that's because despite the fact that you've got a CEO who's been in place for a long time, that, we've got Sheryl Sandberg exiting and she's the seasoned COO there. The other thing is that Meta has started over the last 12 months to dip its toe into new business lines that are completely uncertain as to how they'll develop through this next phase of economic uncertainty we've got in the US. Then there are others. When it comes to Microsoft, we still don't know what's going to happen with some of its big gaming plays. It's got a very strong balance sheet. But when I look at the relative values here, I'm looking at Amazon and I'm looking at Alphabet as being surer bets over this next Q3, Q4 period.
Now, when it comes to this idea of kind of what to avoid, there are still certain places, maybe outside of mega cap technology. It's been the consensus trade, and I bring it up for such a long time that whenever there is a market downturn, you kind of just go back to the same thing that you know and love, which is those mega cap technology names. But elsewhere, is there anything outside that area that still kind of catches your attention besides the fact that we can see Apple and Microsoft maybe catch a bid at some point because of this kind of return to safety trade?
Yeah, absolutely. And to your point, those big tech names are returned to safety. What I'm doing at the moment is doubling down on those at the same time as looking at where there may be more interesting opportunities that flourish over the longer term. And one of those is Warner Music, one that I've discussed on this show in the past. Spotify's results, if you look at what they just disclosed to the market, were extremely strong. So that's a European stock. It's not a US stock, but saw 30% growth in revenue, extremely strong numbers of subscribers. Morgan Stanley issued a report saying they expect music streaming subscribers to double between now and 2031. And so I look at that macro tailwind, and I look at Warner Music that's now beginning to lap some of its self-inflicted issues and think that's one that's positioned to do pretty well, one, through a recession, and two, longer term.